Hello and welcome to the Corporate Finance reading. My name is Christiana Sembi. I don't think you will have met me before. I'll be taking you through this reading. And just before we start, I just want to let you know that actually I think corporate finance is a really good news area. The reason being there's a fair amount of repeat within this section of stuff that you will have seen before. So my advice would be you might want to skip this section now, cover the rest of the syllabus and then come back and do this reading at the end, because what you'll find is you'll be able to whiz through it, because a lot of the concepts that come up here are concepts that you will have seen elsewhere, and it will just mean you get through it a lot quicker. But if you want to stick with me and you want to carry on and you want to do all your readings in order, that is absolutely fine. I'm going to assume no knowledge, so we will be doing everything from scratch, assuming that you haven't seen it before. All right, so scenario behind the corporate finance reading. Imagine you are the finance director or the CFO of a corporate. So you're now working for the corporate. And as the CFO, you are responsible for making a lot of decisions. Some of the key decisions you have to make will revolve around investment appraisal. So there will be a variety of projects that the company has identified that they would quite like to do, and it's up to you to analyse those projects and determine which ones we should do, which ones are going to increase our shareholders' wealth, which ones are going to make our shareholders richer. And there's a number of investment appraisal methods that we'll introduce. Some of them you've seen already within quants, which is nice, so it will be a bit of revision. But that's what we'll start off with, and that's this capital budgeting reading. So let's jump in. So we've got the first learning outcome statement asks you to describe the capital budgeting process. So here you go, you've got a definition. The capital budgeting process is used to determine and select profitable or the most profitable long-term projects greater than a year. So like I said, we've identified a number of projects we want to do, but we only have so much cash. Which projects should I do? Okay, so what we first need to do is describe the steps in the capital budgeting process, nothing too complicated here. So step one, we need to identify the potential projects. So that's the idea generation. Step two, we need to analyse the project proposals. This is what this reading focuses on. All right, what are the various investment appraisal methods that we can use to analyse projects? What are the advantages, disadvantages of the various investment appraisal methods? Step three, then, once we've identified the projects, we need to figure out how much cash we have to invest in the project, so create the capital budget for the firm. And finally, as always, we need to monitor our decisions and conduct a post-audit. So compare actual numbers to our forecast, projected numbers, how good were our forecasting skills. We should do that post-audit analysis. So types of capital projects that we can do. We can start off with replacement projects to maintain the business, so just replacing maybe existing fixed assets. That's not going to be that risky a project, in which case isn't going to require as much analysis. Replacement projects for cost reduction, okay, maybe we need a little bit more analysis there. It's really once we get into expansion projects and new products or markets that the risk increases, because now we've got a lot more uncertainty, we're expanding, we're entering, developing a new product, we're entering into a new market, and the more uncertainty we have, then the more risk involved, and therefore the more detailed the analysis needs to be. Mandatory projects, health and safety, etc. Well, we have to do those anyway, so again, probably not going to require as much analysis as the previous ones. And then any other projects, so pet projects of the CEO, research and development, etc. All right, starting off with principles of capital budgeting. Our decisions are made based on the changes in after-tax cash flows. So that's the key point. We are looking at cash flows, not profits. We are looking at incremental future cash flows. So any costs that we have incurred in the past are irrelevant to my decision today. They are sunk costs. We ignore them. So for example, I have a project that requires the use of copper. We actually have some copper sitting in the warehouse because we bought this copper 5 years ago for $2 million. And I can use that copper in my project today. The fact that it cost me $2 million 5 years ago is irrelevant. That money's been spent. It shouldn't factor into my decision making today. However, what should factor into my decision making is what else I could use that copper for, or maybe what I could sell that copper for. It could be that that copper could be sold for $5 million today. That is actually the cost that is relevant for my project. If I didn't use the copper in my project today, I would have sold it and I'd have $5 million. That's the opportunity cost. So we ignore sunk costs, but we do take into account opportunity costs. Externalities are a very similar idea to opportunity costs. The idea here being your project is you are introducing a new product, and actually that new product might take away from the sales of an existing product. So for example, I don't know, we're Coca-Cola, so you've got your Coca-Cola sales, and then all of a sudden Coca-Cola, one of their projects is they're analysing whether to introduce Coke Zero. Well, potentially the people that drink Coca-Cola might switch to Coke Zero. That is a cost of the Coke Zero project, okay? That is your externalities, cannibalization of an existing product. Timing of cash flows is important. Why? Because of the time value of money, all right? We're going to forecast these future incremental cash flows, and as always, we're going to discount them. So we need to take that into account. Project interactions, we need to compare independent projects or consider independent projects versus mutually exclusive. What do we mean by independent, mutually exclusive? So mutually exclusive, where you are looking at two projects, but you can only do one. So I cannot do both. I've got project A, I've got project B, and I'm deciding which to invest in. I can only do A or B. I cannot do both. So even though if they are both profitable, if they are both increasing my shareholders' wealth, I can only do one of them. Whereas independent projects, I can do both of them. All right, doing one project does not affect my ability to do another. Project sequencing, opportunity for profitable future projects. Well, what order should I do the projects in? I should probably do the projects that have the highest net present value first. The projects that are going to make my shareholders the richest, they're the ones I should allocate capital to first and then work my way down. And what is the scenario that we find ourselves in? Do we have unlimited funds or do we have capital rationing? Obviously, if we have unlimited funds, then we are going to do all positive net present value projects. Whereas if I'm capital rationed, which projects should I do? The ones with the highest net present value. All right, so let's have a look at NPV. It's a little bit of a recap of quant, so hopefully we are familiar with this idea. So we're going to forecast those incremental future cash flows, and then we are going to discount them. And you can see maybe in the quant reading you would have discounted by 1 plus R. You can see here we're using K. It's the discount rate. We'll probably refer to it in this reading as the cost of capital. So just remember that the discount rate is the same as the cost of capital. It's the same as the investor's required rate of return. It doesn't matter what you call it. It's the rate that you're going to use to discount your future cash flows. We have our initial cash outflow here. So you're going to have an initial cash outflow, and then you're going to have a series of cash inflows that you are going to discount to give you a net present value. And as always, the rule is if you have a positive net present value, then you should take on this project. Because what does that mean? It means the present value of your future cash inflows are bigger than the present value of any cash outflows. So we've got an example here, assuming a cost of capital of 9%. We are investing $100 today, and then in year 1, we're getting 25 back. In year 2, we get 50 back. In year 3, we get 75 back. Should I do this project? Well, if I'm just looking at those numbers, I can't tell, because the year 3 $75 isn't worth as much as $75 today. So I need to discount those cash flows. So if we were to do this manually, we would divide the 25 by 1 plus 9%, so 1.09 to the power of 1. We would divide the 50 by 1.09 squared and the 75 by 1.09 cubed, and that would give you the present values that you have in that third column. And if you add those up, as they've done over here, we've got a net present value of 22.93. So should I do this project? Absolutely. The NPV is positive. Therefore, I should do this project because it will increase my shareholder wealth by 22.93. The company will be more valuable now by $22.93. by doing this project. Now, how would you do this on your calculator? So I'll just quickly run you through the inputs. If you grab your calculators, this is the Texas BA2 Plus that I have here, then you want to go into your cash flow mode. And if you hit cash flow, then you can see you get CF0. Now, I want you to get into the habit, because if you've used this before, then you'll have a number in there like I do. So you need to clear the worksheet. So second and clear worksheet, make sure you do that. So we clear any data that's been input in there before, and then input our numbers. So what did we have? CFO is equal to minus 100, and then hit enter, because you've got to hit enter to store it, and then arrow down. It then asks you for CO1. What was CO1? Was a positive cash inflow of 25. Again, enter, arrow down. If you arrow down, you get FO1, frequency. My advice to you would be to avoid using frequency, just because if you use the frequency, so if you've got, let's say, 3 cash flows of 25 coming up, you could just put in CO1 25 and then frequency of 3. The problem is when you arrow down, your calculator will still be talking about CO2, but you actually are now looking at, you've got CO1, CO2, CO3, so you're now on CO4, and then you're looking at your paper, your exam paper, where you're looking at the 4th cash flow, but your calculator is talking about CO2. I just think it's too easy to make a mistake. So my advice would be I just input 25 3 times. It doesn't take that long. So I would skip the FO1. Just leave it as it is. I think the default is 1. So if I just put in a, there we go, yeah. So, and then enter, arrow down, just arrow down past it. CO2, we had 50. Again, enter, arrow down, skip FO1, so then FO2, sorry, so then you've got CO3, which is 75. And then enter. So once you've put in your cash flows, the next thing you need to do is go to your, if you just look right next to the cash flow button, you've got net present value. And if you hit net present value, then you get I is equal to, and it will just say 0 on your calculator. So this is asking you for the interest rate or the discount rate or the cost of capital, whatever you want to call it. So we can put in our cost of capital, which was 9, and you put it in as a whole number, not a decimal. It knows it's an interest rate. You don't need to put it in as a decimal. So 9, enter, arrow down. You have NPV. At the moment, it's probably saying NPV is equal to 0. What I would then do is hit compute, and you should get an NPV of 22.93, which is the same as what we had on the slide. Okay? So that's how I would do it on the calculator. That should be a bit of revision from quants. You've seen this before. Okay, so what else do we have? Right, we've got a definition here. So net present value is the expected change in the value of the firm in current present value dollars from the project. Key point is accept projects with a positive NPV, as that is going to increase the value of the company and therefore increase your shareholder wealth. So there's your NPV decision rule down below. Brilliant. Okay, moving on to the IRR. The IRR is defined as the expected return on the project. Think of it as the annualized return. And then you've got this definition here. Technically, the IRR is the discount rate that equates the present value of the project's cash flows to that initial outlay, i.e. it's the discount rate that gives you a net present value of 0. If I draw a diagram here, if we were to plot the net present value against the cost of capital, if we have a normal project, and a normal project is defined as an initial cash outflow followed by a series of cash inflows. So we've only got that one change in sign. We've got a negative today, and then we've got lots of positive cash flows coming in. Then you can see as the cost of capital, as the discount rate increases, we are discounting those future cash flows at a much higher rate. Therefore, the higher the discount rate, the lower the present value. And so our project looks something like this. And the IRR is this point here. Okay, now you can see from this diagram then quite easily what the decision rule should be. If, let's say, the IRR is 10%, then clearly if my cost of capital is lower than 10%, so say 5%, then I should take on this project because you can see it's giving me a positive net present value. Whereas if the cost of capital is 15%, you can see that project is actually generating a negative cost of capital. And I think the decision rule is quite intuitive if you talk about cost of capital and annualized return. Should I do this project? Well, if it's going to cost me 5% to raise the finance, so my investors require 5%, so it's costing me 5% to invest in a project that's going to generate 10%, should I do it? Well, yeah, it makes sense to do it. Should I do a project if it's going to cost me 15% to raise the finance and I'm going to invest those funds in a project that only generates 10%? Well, no, it doesn't make sense. So I do think the IRR rule is quite intuitive. So if we go back to our slide, there you go, the IRR there is the discount rate that makes the NPV equal to 0. And we've got a little example here. So it's the same example, initial cash outflow of 100, we've got 25 in year 1, 50 year 2, 75 in year 3. And then you can see that if they discount them at 19.44%, then if you add up those cash flows, you get a sum and a net present value of 0. So that has to be the IRR. Now you might have to calculate the IRR in your exam. Really easy. Okay, pick up your calculators again. You've put in your cash flows, so same as before. You've got your CFO is minus 100, CO1, CO2, CO3. So if you've still got those cash flows in your calculator, if you haven't deleted them, then brilliant. All you now have to hit is just next to the NPV button, you have an IRR button. So if you hit IRR, again, it's going to say 0, but then if you hit compute, then you should then get 19.44. Okay, so actually doing IRR calcs is quite nice. Okay, so there's your decision rule, the IRR decision rule for independent projects. Accept all projects with an IRR. Remember, interpret the IRR as the annualized return of the project. So when the annualized return is greater than the cost of capital, then do it. Okay, that's the equivalent of an NPV greater than 0. Brilliant. Okay, we do have some other methods that you may not have seen before. So the payback period focuses on how quickly do you get your money back. And the quicker you get your initial investment back, the better. So this is primarily a measure of liquidity. The better projects are the ones that pay us back the quickest. So what is our target? Well, it's just an arbitrary number. It could be we decide, right, we want to be paid back within 5 years. Therefore, any projects that pay us back within or before 5 years, we will accept. Anything that pays us back beyond 5 years, we will reject. So we can see how to calculate this in a sec, but there are a number of limitations with the payback period. As you can see, the big one is it's not a measure of value. I'm totally ignoring cash flows after the payback period, and it could be that I accept the project that pays me back in 3 years and reject the project that pays me back in 6 years, but actually the 6-year project is the one that increases the value of the firm the most. Maybe that one in the year 7, year 8, year 9 cash flows are really, really high, whereas the project I've accepted that paid back in 3 years actually doesn't have great cash flows, but it just pays me back earlier. So we're ignoring value. It's not about increasing shareholders' wealth. It's about liquidity, getting my money back as quick as possible. We're ignoring the time value of money, although we can deal with that because we can do a discounted payback period. So I'll show you how to do that in a sec. And I've already mentioned this point, we're ignoring cash flows beyond the payback period. So how do we calculate the payback period? So here we go, same project, same cash flows. So the way to do this, all right, we can just create this third column and call it the cumulative cash flow, whereby we look at our cumulative cash flow position at the end of each year. So at the end of year 0, I am down by minus 100. Then I get 25 in, so now I'm only down by 75. Then I get another 50 in, so now I'm only down by 25. And then finally in that year 3, I get the 75, and so now I'm up. So we can see that we are clearly breaking even. We're getting our money back between years 2 and 3. So how far of the way between years 2 and 3 am I? We assume that that 75 cash in year 3 is generated on a linear basis. So I can simply prorate. So I can take, I get paid back after 2 years plus and then 25 over 75 to get how far of the way through the year we are. So 2.33 years, so 2 1/3 years, I recover my initial investment. Now again, you can do this on your calculator. So this is a way to do it manually. You can do it on your calculator. If you go back to your NPV button on your calculator, and if you arrow down, you've got the interest that you've put in. Well, we're not discounting it, so it actually doesn't matter what I put in here. If we arrow down, we then get the NPV that we calculated earlier. If you arrow down again, then if you've got the BA2 Plus Professional, you'll see the net future value. If you arrow down again, then you'll see PB. Now, if you do PB and compute, it should give you the payback period of 2.33. So really quick and easy on your calculator. Discounted payback. I'm now just going to discount these cash flows. So again, assuming a cost of capital of 9%, the 100, I'm paying that out today. 100 today is worth 100. In a year's time, I pay out 25, but I need to discount that by 1.09, 1.09 squared, 1.09 cubed. That then gives me the discounted cash flow, and then I do exactly the same as I did before. We've got our cumulative column. And you can see again, I'm getting paid back between years 2 and 3. I go from negative to positive to find out how far of the way through the year I am. It's the same process. So take the 34.98 and divide by the 57.91. And you can see, because we are now discounting the cash flows, those future cash flows, it's taking me longer to get paid back. If you have this calculator, the BA2 Plus Professional, then actually your calculator does this for you. So if you arrow down one more time after your payback, then you get DPB, and that's the discounted payback. So again, it's just hit compute and you will get the 2.6. If you have older versions of this calculator, then, or the HP, I'm not so sure about the HP to be honest, but if you've got an older version of this calculator, you don't have this discounted payback function, in which case you will have to do it manually. You will have to create this table and do that final column and see where you're at. But it doesn't take that long. Okay. All right, our fourth method, so we've looked at NPV, IRR, payback, and then our fourth investment appraisal method is the profitability index. Pretty similar to the NPV really. It's the present value of the future cash flows divided by the initial cash outlay this time round. So you can see, obviously we would do a project if the present value of the future cash inflows are bigger, are greater than the initial cash outflow, in which case we need this to be greater than 1. So I can either write it out as the present value of the future cash flows over the initial cash outflow, or we can rearrange this to 1 plus the NPV. If we've got a positive NPV project, again, we're going to be greater than 1. So here we go, independent projects, except all projects where your profitability index is greater than 1, because that means the present value of your future cash inflows is greater than the initial cash outflow. All right, now let's have a look at what happens if I'm looking at 2 projects. I've got project A, project B, and let's have a look at which project I would choose if I analyze the projects using the IRR method versus the NPV method. So This is similar to the graph that I drew earlier. So there's your y-axis, this is the NPV, the x-axis is your cost of capital. As the discount rate, the cost of capital increases, the NPV is coming down. These are clearly normal projects. And we've got project A and project B. So if we start off with IRR, we can see project A has an IRR of 8%. Project B has an IRR of 15%. So based on IRR, which project would I choose? Well, I would go for project B because an annualized return of 15% is better than an annualized return of 8%. So I would pick project B. If we were doing this based on net present values, and let's imagine here we can only pick, we can't do both of these projects, we can only pick one, so these projects are mutually exclusive. Well, if I'm looking at NPV, then actually for cost of capital of 15% coming down to this 4% here, I would pick project B. I would make the same decision as IRR because you can see the net present value is higher. But once we get to this 4%, then actually the net present value of A is higher than project B. So for cost of capital or discount rates of less than 4%, I would rather do project A. I would make a different decision. So actually, depending on what the cost of capital is, will affect the decision that I make for NPV. For IRR, I don't really take that into account. I will just pick project B. So let's imagine we do have a cost of capital of 2%. I would still, under the IRR method, pick project B because 15% is better than 8%. But if I was doing this using NPV, I would have picked project A. So we are coming up with different decisions. Who do we listen to? NPV or IRR? Always, always, always net present value. Net present value is superior to IRR. IRR may lead us to make the wrong decision. In this case, for cost of capital of less than 4%, IRR is telling us to pick the wrong project, whereas net present value will always tell us to pick the right one. It tells us to pick project A if the cost of capital is less than 4, and if the cost of capital is greater than 4, it tells us to pick project B. So we will always make the right decision using NPV. We may make an error. We may pick the wrong project if we use IRR. That 4% is known as the crossover rate. So that is only an issue for mutually exclusive projects. You can see this first bullet point here. For independent projects, IRR and NPV will give us the same accept, reject decisions. So not a problem if I can do both projects. However, we have an issue if our projects are mutually exclusive. So that's the key thing to remember. For mutually exclusive projects, IRR and NPV may give us different results. IRR may tell us to do project B, whereas NPV tells us to do project A. Why are we getting different results? It's all to do with the fact that potentially the projects have different timings of cash flows, the projects are different sizes. IRR is a relative measure. So it's telling me that an annual rate of return of 15% is better than an annual rate of return is 8%. Well, yeah, that's true. However, in absolute terms, depending on the size of the project, making 15% on $1 is not as good as making 8% on $100,000. All right, so if the projects are different sizes, then NPV and IRR may give us different answers. There is also another reason we prefer NPV, this to do with the reinvestment rate assumptions. The IRR assumes that cash flows are being reinvested at the same internal rate of return, which is quite an unrealistic assumption. If this is our best project that we've identified that's generating us the highest IRR, the assumption that we're then getting cash flows and reinvesting them in another project that is generating just as high an IRR is fairly unrealistic. Whereas the NPV assumes the cash flows are being reinvested at the cost of capital, which is a more conservative assumption. Another issue with the IRR. We might have multiple IRRs or we might have no IRRs. And if we've got multiple IRRs, then which one do we pick when making our decision? If we have no IRRs, then we're pretty screwed, aren't we? So let me illustrate what's going on here. So going back to our diagram of the NPV versus the cost of capital. If I've got a normal project, then we said it looks like this. Remember, a normal project is an initial outflow followed by a series of cash inflows. But what if I have another change in sign? What if I have an initial outflow and then we've got inflow, 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 and then a big outflow again? That big outflow in the future is going to change the direction of this graph. So what might happen is we have something like this. We're coming down because we've got outflow, inflow, 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 and then we've got big outflow. And that changes the direction. And so hence, I end up with two IRRs. It might be that we're going down, 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 and then we've got a big outflow and we change direction before we even get to the x-axis. So we have 0 IRRs. So the problem is whenever there is a change in sign. So if we go back to our slide, here we go. Potential problems if the project's cash flows change signs more than once. So outflow, inflow, inflow, outflow, inflow, outflow. Okay, those changes in signs change the direction of my graph, which means I cross that x-axis maybe not at all or a multiple number of times. So you could get exam questions along the lines of, okay, there are 3 changes in signs in this project. How many IRRs could you have? And the answer to that question would be, well, you could have 0 IRRs, 1 IRR, 2 IRRs, or 3 IRRs. So the number of IRRs you may have is anything up to the number of changes in sign. It could be 0, it could be 3, or anything in between. Whereas NPV does not have any of these issues. Hence why NPV is the preferred investment appraisal methodology. So the next learning outcome statement asks you to describe the effect of the net present value on the stock price. So we've got a definition here. The net present value is a measure of the expected change in shareholder wealth from a project. Well, yes, as we know, if we have a positive net present value, then that is the increase in the value of the company and therefore the increase in my total shareholder wealth. Well, if I take that NPV and I divide by the number of shares, that should then give me the expected increase in the share price. And that is it for capital budgeting. So I hope that was useful.